The financialization of companies is a relatively recent phenomenon, let's say over the past 20 to 30 years. Generally, it does not have a good reputation. This financialization is often wrongly, denounced as a perversion serving shareholders at the expense of the company itself, its employees, or its customers. But what exactly is the financialization of companies? Financialization is simply a mechanism for optimizing company management that relies on financial reasoning. This encompasses three main concepts. The first concept is the definition of the company as the property of its shareholders. This is a foundation of capitalism, where shareholders provide the capital necessary for companies to operate. The second concept refers to the risk-return trade-off, which is the foundation of modern finance. Basically, if I want a lot of profitability, I have to take a lot of risks. If I don't want to take a lot of risks, I won't have much profitability. The combination of these first two concepts leads to the suggestion that the company, as the property of its shareholders, should be managed in their interest. That is, it should maximize its profitability, also known as value creation, according to the level of risk borne by the company. The third concept is that value arises from the company's strategy, from its competitive advantage, from what makes customers choose its products or services over those of its competitors. Financial reasoning does not create value in itself. It optimizes the value that is created. Financialization then consists of trying to maximize the profitability risk balance resulting from the competitive advantage from a shareholder perspective. But concretely, what are the consequences for business management? Financialization involves implementing a range of measures which, while rarely strictly financial in nature, are based on an underlying reasoning of optimizing the risk-return trade-off. A few examples. First, cost reduction. This is the most obvious measure, even though it is not always easy to implement and sometimes can lead to excesses, such as cost killing, as illustrated very well by the recent troubles of the American food company Kraft Heinz. Next, asset lightening. To improve the profitability of assets invested in the company, it is necessary for a given level of activity and profitability to reduce assets. In practice, this has resulted in outsourcing policies for activities that are not part of the company's core business. Logistics, security, information systems. By implementing production management techniques aimed at reducing the company's working capital requirements, just-in-time, Kanban, lean management. And by selling real estate assets that tie up financial resources which could otherwise be used for business development, opting instead for leasing. The French hotel group Accor has thus gradually divested itself of ownership of its hotel properties. The sale of real estate assets allowed it to free up resources that it could dedicate to its development, notably to the acquisition of competitors such as the Swiss company Movenpick. Another example is financial leverage. This involves increasing the proportion of debt at the expense of equity in the company's financing, which makes it possible to improve profitability for shareholders. Let's be fair, this is not necessarily a recommendation of financial theory, because while the expected return does indeed increase, so does the risk. Nevertheless, in the current period, marked by low interest rates, companies' financial leverage has increased significantly, and it has also led to more questionable operations such as LBOs, some of which, moreover, end badly. Here we can think of Solocal, the Yellow Pages, or the French water management company, Sour. Next illustration, the specialization of companies and the refocusing of their activities. This refers to the need to make the company's risk clear and accessible for shareholders, who must diversify the risk of their own investment portfolio. This leads companies to refocus on their core business and a single activity so that they can rely on a sustainable competitive advantage, one that is noticeable to customers and profitable. In fact, today in Western countries, most companies are specialized and not diversified. This focus on the core business has very significant economic consequences. Mergers and acquisitions between companies in the same sector and company spin-offs. Companies are being broken up to create specialized entities, as the French digital group Atos recently did with Worldline. One can even infer that financialization is a key explanatory factor in globalization. Since companies can no longer find sources of growth through diversification, they are led to leverage their competitive advantages on a global scale to find opportunities for growth, whether through internal or external expansion. Finally, corporate governance, recognizing the weakness of mechanisms for supervising and controlling executives, has led both theory, specifically agency theory, and practice to develop principles of good governance. They mainly serve to strengthen the authority of boards of directors, whose role is to ensure that executives prioritize value creation for shareholders in their decisions, and if not, to sanction them or even replace them. This representative intermediary body is all the more useful when shareholders are dispersed and not in a position to assert their rights. The list of financialization tools could be extended even further, but these few examples seem sufficient to understand the logic at work in contemporary business life.